So good afternoon. Welcome to TaxAssist and our latest webinar. And this webinar today is on landlord, accountancy and tax issues. So thank you for joining us. We'll start with a bit of background. So TaxAssist accountants, some of you may be clients, some may not be. For those of you that aren't clients, we are a network of accountants across the UK and we represent about 370 locations. And give or take about 78,000, mostly small business clients. So our background is very much in this small business and individual market, and our role here at the support centre is to look after our network and in turn look after our clients. So my role is as Group Commercial Director, so I look after a number of different aspects for the network, including a lot of our COVID response. And my background is about 25 years in practice, so I spent most of my professional career supporting individuals and small businesses through a whole host of different things, which is why I'm helping support on the landlord side. I'll let Gary introduce himself and give you a bit of background for him.
Hi, my name's Gary. I've been in and around tax for 30 years. Started in the late 80s. I've mainly been based in North where the support centre is located, which is a huge market for landlords and rental property. So I do have quite a bit of experience. I'm hoping to pass on some of that those details to you today.
So the two of us will be guiding you through a number of slides. We think it's somewhere between 30 and 40 minutes. We'll see how we go time-wise. We will be recording this webinar, should you wish to come back to it. So that will be available on our website. And we will try and take some questions at the end. Depends on timings. We've already had one or two questions sent through, but we will try and cover questions at the end. So please do put those questions in if you need to. If we don't find time at the end, then we'll get back to you individually to try to help you. But we will try and deal with those as we go along because it will bring some of these topics to life. And you'll see on the screen what we're covering. I won't read those one by one, but there's actually quite a bit there. And I think it's safe to say that the landlord sector, if you want to call it that, is actually quite a complex one. And it covers a multitude of activities from single properties and people looking to become landlords for the first time, through to some quite sophisticated large-scale landlord businesses and anything in between. So we're going to try and give you a flavour of lots of different things today. We'll give you some updates on things that we think are relevant. We'll give you some tips of areas that we think are relevant from a planning point of view. And we'll try and give you as much of an overview as we can. Bear in mind that there may be more detail needed on a number of these things. That's where we come in as a network of accountants, that follow-up help. But we'll start by looking at something quite topical, which is coronavirus. So we'll just talk about some of the things that have changed with coronavirus, both generically and in terms of this sector. So if we just flick forward on the slide. So just a bit of background on the virus, and it's difficult to do anything really without referring to this in a moment. It's impacted upon pretty much every sector of UK, individual and business. So it's difficult to avoid it, and there are lots of things that have been done in response to that, some of which are relevant to the landlord space, as we'll come on to. Our role has really been to help our network through this and in turn help our clients. Hopefully those of you who are out there who are clients have seen the regularity of communication from us and from your accountants being really important to keep you up to speed in these difficult times, and we'll continue to do that. Those of you that haven't, that's certainly one of the benefits of working with somebody like a TaxAssist accountant. We can do an awful lot to help you, particularly when there's an awful lot changing, which is at the moment. Those changes include things in the landlord space. So I'm going to let Gary just talk you through some things that are relevant over the past few months and particularly affect you. So Gary, I'll let you just talk through these.
Yeah, I just want to pick up on the most topical aspects of coronavirus and how it's impacted on landlords. As you can see, the first bullet point deals with the 3-month notice period, which the government have insisted that landlords use. So whereas you may have been able to instigate some court proceedings to remove a difficult tenant, for example, you've now got a 3-month notice period within which you need to do that, and also that the impact of that is that court proceedings can't actually commence until after the 24th of August. But that is matched by the fact that the government has insisted to all lenders that they provide the potential of a mortgage payment holiday for 3 months. So if you do have a difficult tenant, then hopefully, if your business is financed, then you can make use of that. They recently extended the deadline for new applications for mortgage payment holidays to the end of October. So that could potentially, if you haven't already taken advantage of that, take you around to the end of January. And fingers crossed, a lot of this will be out of the way.
And lenders don't necessarily tell you about those payment holidays in our experience, do they? It's really a question of finding that out and taking action yourself. I think that's how we've seen it.
Yeah, so the key is to talk to your lender. The key for landlords is to talk to their tenants and make sure they're okay, so there's no nasty surprises. There was a question mark about whether tenants could carry out necessary repairs to properties during the coronavirus period. The guidance was that, yes, essential repairs should be carried out, except in the case where the tenants are shielding. But the government recently announced that from the 1st of August, so this month, even if the tenants are shielding, if there's essential repairs, gas safety checks, etc., which need to be carried out, then they can be conducted from now. But obviously, you need to speak to the tenants and get their permission to do that. So those are the main points that we see being affected by the coronavirus. From a tax perspective, a lot of landlords will be paying what are known as payments on account. Now, if your tax bill is more than £1,000 each year and less than 80% of your tax is deducted at source, then you can take advantage of the payment on account holiday. So that will be automatic. So if your accountant has said that you have a payment due by the end of July, you can actually defer that until the 31st of January without there being any interest or penalties in relation to that payment. Not many landlords are VAT registered, but we do have some VAT registered landlords, for example, if they're providing holiday accommodation at a pretty substantial scale. If they do have any VAT due for the period 20th of March to the 30th of June, they can defer that VAT until the 31st of March 2021. So that is an automatic deferral, but it does mean that if you have a direct debit in place, you need to cancel that direct debit and then reinstate it forthwith after the 30th of June. So you should already have done that.
There's a small typo there in terms of the deferral of payment on account to 2021 or 2020, so apologies for that. But I guess the important point to note on both the payment on account point and VAT is obviously that's a deferral. It's not waiving any amounts, it's just deferring. So one of the things that individuals and small businesses are now needing to consider is, okay, what happens when that amount is due? So there's something to bear in mind in terms of cash flow. It is just a deferral. Yes, 2021 feels some way off, but it is a question of thinking about cash flow and planning for that when those amounts do eventually fall due.
One of the other support schemes in place is the self-employment income support scheme. Now, 99% of our landlords won't unfortunately benefit from that scheme unless they have a proper self-employed business. So if you're running your property as a bed and breakfast and are genuinely self-employed, then you may benefit from that scheme, but most landlords won't. We have seen some cases where landlords have declared their income on the wrong pages of the tax return previously, where they've done their own tax returns. So we've helped them sort that out, because there's quite stiff penalties for taking payments from these schemes which aren't due. So we have dealt with those kind of scenarios as well.
And I think that the list we've come up with, and there's a fair bit there, isn't there? This is all coronavirus impact as it stands. Who knows where the government will go over the next few months? There's lots of speculation, isn't there, in terms of what may or may not happen. Our job is to keep our network and their clients informed, so we'll continue to communicate, because it is fast moving at the moment, more so than probably ever before. So who knows what's around the corner? But that's a summary of things that we've noticed so far, isn't it?
So we're going to move on to something which is slightly technical, cash basis versus the accruals basis. So just move on to the slide. So what that means is if you're operating something called the cash basis, that means that your income is taxed when you receive it, and your expenses are deducted when you pay them. Now, there may be some people who are also completing their accounts on the accruals basis. So what that means is if you received a lump sum of rent, say towards the end of a tax year, and it doesn't relate to that year, it will be pushed into the following year. So you're being taxed on that rent for the period it relates to, and the same with your expenses. Up until quite recently, so 16, 17, all accounts had to be done on the accruals basis, except where your income was relatively low, so about 15,000. But now the default position is that the accounts need to be completed on a cash basis, but you can elect on the return for them to be done on the accruals basis. So there's been a slight change from the tax office in their emphasis as to the way.
So any landlord could choose to look at it from an accruals basis rather than a cash basis.
Yeah, yeah.
So just a planning piece in terms of, so if they, for example, received, I don't know, 2 years of rent in advance, as a slightly extreme example, and wanted to spread the tax impact of that, then you could choose to put it onto an accruals basis.
Yeah, exactly. Yeah. I mean, in a lot of cases, it won't be materially different because you'll be receiving the rent on a monthly basis. So chances are it'll just be a month out. But for example, if you're paying for insurance and things like that, then they have to be split over tax share, period to which they relate.
So just a planning piece for people to consider when they're talking to their accountants about what may be best for them.
Yeah, and dealing with bad debts as well. If you've got a tenant that you're unsure as to whether they're going to pay or not, if you're on the cash basis, then if they haven't paid, then you don't pay tax on it. If you think they're going to pay you and you're on the accruals basis, then you have to pay tax on that, and then claim a bad debt relief afterwards. A bit more work there for you. Going to move on now to finance costs because they're particularly relevant, especially when we look at the slide and we can see how things have moved. We're now in a situation, so the current tax year 2021, where people are only going to get basic rate reductions for their interest. So if you're a high rate taxpayer, you'll pay tax on the rental profit before the interest, and then the tax relief on the interest will be given by a deduction at the bottom of your calculation. So you're not going to get high rate relief on your interest. But that's sort of decreased on a sliding scale since 2017-18, as you can see there. So if you've got incidental costs of finance, so if you're paying brokers' fees to remortgage, then they're all treated in the same way. So we'll come on to later some of the tax tips that we've been looking at. So for example, how flexibility of sharing income between spouses, for example, and where we can bring in some of these planning points.
It's a common misconception, this one, isn't it? Because people imagine they're high rate taxpayers, they generate some income, they've got some finance costs to offset, they imagine that they're going to pay tax on the profit effectively, on the net amount, don't they? Yeah. This actually can substantially increase the tax bill, can't it, because of that restriction around basic rates. So there's a planning point around that in terms of, I guess, where the income's attributed, isn't there?
Yeah. If your business is really highly geared and you do have borrowings, then there's definitely some planning that can legitimate planning, which is what we tend to stick to.
Oh yes, tax planning is legitimate, quite right, and we'll come on to that at the end, won't we, in terms of some tax planning ideas, of which this is one. So that's the tax relief position. I think it's probably worth just a very quick update on what we call the commercial. So the reality of the finance market, we stay relatively close to the finance market across our network. We've got a number of partners that we work with as a network we recommend who can help in a number of areas. It's worth just stepping back and maybe shopping around a little bit on this one. Our understanding at the moment, a lot of the finance market is being geared up around government intervention schemes, so bounce back loans and what are called CBILS intervention loans that are out there. So there's been a huge focus around delivering that for small businesses in particular. So lenders have stepped away from more traditional lending in some ways, and that's been true in the residential market, property market, and landlord-specific lenders as well, to a certain extent. They are now starting to become more active. It is worth shopping around for the best deal. There are some fairly significantly different rates out there. But bear in mind, it's not just about the headline rates. It's about the deal structure, repayment terms, penalty clauses, a whole host of things in there that may be relevant to you. So worth shopping around for the best deal. And sometimes, as I say, it's not just about the headline rates. If you want more information on that, because it's quite a big topic in itself, funding, we are running a funding webinar for small businesses on the 19th of August. Details on our website if you are interested in looking at some of the the different and more innovative funding options now available. We're partnering with another provider, Funding Circle, on that one, who provides some interesting funding options. So that may be worth you looking at if funding is relevant to you. Okay, thanks, Gary.
The next thing we wanted to look at was furnished holiday lettings. Don't want to dwell too much on the coronavirus, but I think inevitably that will mean that people are going to be tending to holiday in this country, and some landlords might be looking to switch over to provide that accommodation to people.
Yeah, we've seen second homeowners look at perhaps using their property differently, haven't we? And we've seen investors actually looking at different homes for their money and looking at second properties with a view to perhaps holiday letting. So I think you're right, these rules are particularly relevant now, aren't they?
Yeah, I mean, there are some rules that need to be adhered to. I'll just quickly run through them. So total lettings that exceed 31 days or more for 155 days, the property won't qualify, unfortunately. The property's got to be available for at least 210 days, and that's not counting days that maybe the owner or his family might be there. It must be actually commercially let, so that doesn't mean let to friends at a discount or used by yourself, for a period of at least 105 days. And in that period, if you let it more than 31 days, those days don't count towards that 5 days. But if you've got a tenant who, say, booked 4 weeks and they have to stay, unfortunately, because they were ill, then that isn't counted. So there's a bit of a let out there. What we can help you with is, if you don't think you've quite met those circumstances, there's a couple of things that your accountants can help you with, a couple of elections, which we can look at making for you, so that even though you don't meet the criteria for tax purposes, you are treated as meeting the criteria. So that's why it's important to speak to your accountant and make sure that even if you think you've missed out, maybe you haven't. I just want to run through some pros and cons of holiday letting. So we looked at interest already. So for a higher rate taxpayer, if they were doing a normal residential let, they wouldn't get their tax relief at the higher rate. It's different for holiday lets. You actually get the interest as a proper deduction from your profit. So you're going to get tax relief on all the interest. It's one of the main and most topical points at the moment. Capital allowances are available. Now, capital allowances are available where you buy equipment and furniture for your property, and it's quite a generous allowance because you're going to get, in most cases, the annual investment allowance rate of 100%. So if you buy an item, then the chances are you're going to get 100%.
So full tax deduction for most of the items, most of the sizable cost you incur in terms of, say, fitting out or changing around a holiday let.
The other good thing about holiday let profits is that you can use those as relevant earnings for pension contributions. So at the moment, if you have no relevant earnings, so no employment income, the most that you can put into a pension is £2,880 with no earnings at all. And some people may have took semi-retirement and have more of a passive income from holiday lettings, and they can use those profits to top up their pension contribution. And for those people who higher rate taxpayers, obviously, you're going to get higher rate relief on those pension contributions. There's also a slight relaxation in the way the profits can be shared. So whereas a normal residential let property is shared based on the ownership of the property, subject to some other planning points which I'll come on to, in the case of holiday lets, there is just that bit more flexibility as to who takes the share of the profit. I mean, the tax office say that it is who is carrying on the work, but generally that possibly will be the person with the lower tax rate. So there's a bit of a planning point there.
And holiday properties can be quite family affairs, can't they? Yeah. So I guess what we're saying is it gives a level of flexibility around tax planning around the family. Is that a fair way to?
Yeah, it is. Yeah.
Okay.
Yeah. Entrepreneurs relief. Just a bit of a background about that. That's a capital gains tax relief, which means that if you qualify for entrepreneurs relief, you will reduce your capital gains tax down from a maximum rate of 28% down to 10%. So if you're running your property as a furnished holiday letting, then potentially when you come to sell the property at a gain at some point in the future, then you're likely to pay a lot less tax if it does qualify for being a furnished holiday letting. There are some other tax reliefs, capital gains tax relief in particular, which are available. So rollover relief. What that means is if you sell one property and reinvest the money into another holiday let, you can roll over the gain on the first property into the second one. So effectively not pay your tax then, but pay your tax on the second when you come to sell the second property, unless you want to reinvest again. So it could be a circle that you get into, reinvesting from one into another. I mean, that compares to residential property, where if you sell a property, you're going to have to pay your tax on that property as a gain before you have whatever's left to reinvest into another property. So that's quite beneficial. And the gift relief there is where if you want to give the property to a family member, if it qualifies as a furnished holiday let, then you can effectively hold over the gain. So that means that the recipient of the property, they take on your base cost with the cost of the property to you, and effectively you don't have to pay the tax because you're not receiving any funds. It's a gift. So that's another benefit. Of furnished holiday lettings. Unfortunately, there are one or two things on the opposite side. Potentially, if you're letting the property out through an agent, the fees are likely to be higher. But then again, potentially the income stream is higher. So it's potentially much more time consuming. So you might have to be taking bookings and dealing with changeovers and cleaning and all that kind of thing. Obviously, that can be subcontracted out to somebody else, but still potentially a lot of work for you. Your income stream is obviously potentially more variable, especially in this country when there is a definite holiday season. But again, versus that, there is the higher potential of better returns on that property. One of the drawbacks is that the property is potentially within the scope of VAT. So what that means is if you're generating a lot of income, so above the VAT threshold of £85,000, you would have to register for VAT. And you have to be particularly careful if you're already registered for VAT, because those holiday lets would be part of your taxable income. But there are ways around that. Best thing again to do is speak to your accountant, because we can put things in place to make sure that that VAT position isn't compromised. So potentially you won't have to pay the VAT on holiday letting if you get it structured correctly.
Okay. Incorporation. So yeah, this is probably the most frequently asked question, I think, at the moment, isn't it, around landlords' affairs and their plans for where to put the property, personal v limited company. It's not a simple answer in pretty much any case, is it, really, from experience?
No. In the past, accountants have been able to generalise on things, but in this particular case, it's very difficult to generalise. There's so many different taxes to take into account, and the interaction of them, is going to be unique for every client. So, what we do want to do is spend the time with you to determine what your goals are. You may be considering just investing in one property, or many more properties, and we need to consider stamp duty, income tax, corporation tax, capital gains tax, inheritance tax. That they all interact in some way. So you may get an income tax advantage in the short term, but that may be compromised by potential higher inheritance tax or capital gains tax in the future. But what we can do is we can compare, we can take, look at your affairs. What is key to this really is having a robust business plan, because it's very difficult to compare the two scenarios without a business plan. A lot of landlords will start off with one property and not really know in which direction they're going to go. But if you have a robust business plan, which we can help you with, then we can definitely compare the interaction of all those taxes and you really need to have some kind of goal and plan in place so that we can determine what the best route would be for your particular circumstance.
And this isn't just a question for those sort of looking at their first venture into becoming a landlord. This is for existing landlords as well, I guess, isn't it? In terms of, as you say, their future plans and what might work for them in what is quite a complex situation.
There are various schemes which are we have seen. We tend to, we definitely stick to the rules. We're not trying to be,
Yeah, I guess the point we're making there is that there's been a number of specialist schemes around landlords, particularly saving stamp duty, I think, in the past that we've seen, which we would consider to be fairly high risk schemes. And those landlords out there may well have seen some of those doing the rounds. There's less of them now than there were, because UK tax authorities have really tried to stop them in recent times. Just as a word of warning, if something looks too good to be true in terms of tax planning, our experience is that it probably is, and there will be risks and issues down the line. What we're saying is, yes, it's about personal circumstances, but there is a place for legitimate tax planning, and that's what we would always try to provide at TaxAssist. Legitimate tax planning, not high-risk tax schemes. So everything we talk about today is legitimate, accepted tax planning technique, I think.
Yeah, exactly.
Okay.
One of the most grey areas is repairs and the allowability of repairs. So I just wanted to touch a bit on the sort of circumstances in which repairs may not be available, or you might not be able to claim them, and some scenarios where you can. So what we often get asked is, particularly from new landlords, they might purchase a property which is maybe in a dilapidated state, and they have to carry out substantial repairs soon after they purchase it and before they let the property. So normally those repairs wouldn't be allowable. Now we can go through the list of repairs with you if you have carried them out to see which ones can be claimed. But generally, that will be included as a capital cost rather than being able to deduct it from your profits. And as I say, there will be some things in there which you can claim. So we can help you go through that list. There used to be something called the wear and tear allowance, which was a deduction of 10% of your rental income. It was quite straightforward, actually. But the tax office have simplified that by bringing in something much more complicated. Which is the replacement of domestic items relief. So this is where it's normally for movable items such as cookers and things like that. And what we want to do is make sure that you set things up correctly in the first place and make sure that you get the tax relief that you're due for those items. And the general rule is that the first cost of them isn't allowable, but the replacement of those items will be allowable. So we just want to make sure that's all structured correctly. The other thing is repairs and replacement of fixtures. So if you've got things like bathrooms and kitchens which are being refurbished like for like, then we should be able to claim those things. It might be quite substantial costs, but people are replacing them. Sometimes there's no substantial improvement, then we can make sure that all those things are claimed.
So just a planning point really in terms of how that expenditure works.
Yeah. We'll move on now to capital gains tax. So obviously that will only impact you if you're considering selling a property. What we want to bring to your attention really is the major changes from 6th of April this year. So where the first bullet point now is where you have a property which has previously been your home, there was a time when if the property had been your home, you had 36 months after you moved out to sell it, and there's still been no tax. Now, a few years ago, that was reduced to 18 months, and from April this year, that period has been reduced down to 9 months. So, what used to be quite a generous relief has been substantially cut. 36 months does still apply if you're disabled or care, but otherwise, what was quite generous relief has been removed. Letting relief was another very, very generous tax relief. Potentially, that exempted up to £40,000 of gains per owner. And what we've seen with that now is that it's still available, but quite oddly, the tax office have introduced a rule that you only get that relief if you were in occupation at the same time as your tenants. Now, it doesn't really make sense, because if you're in occupation at the same time as your tenants, then you probably be wanting to claim rent-a-room relief, and with that goes the capital gains tax relief anyway. So yeah, really, we can't really think of many circumstances where that is going to be available anymore. So if you've asked your accountant for projections of figures in the past, they would have built in that relief. It's probably worth now revisiting those calculations, and asking your accountant what potentially the capital gains tax position is now following these changes. These aren't the only changes. There's also a much shorter time span in which you get to submit your capital gains tax return after the 5th of April 2020. So before, potentially could have happened is you sold a property on the 6th of April in one year, and you get to the 31st of July, not the following year, but the year after that, so potentially 22 months to submit your CGT return and pay your tax. Now, quite often, it would have taken that long, because you're going to have to do some research as to when the property was originally purchased, how much you paid for it, what improvements you carried it out. But where contracts are now exchanged after the 5th of April, your accountant is going to have to submit a capital gains tax return, and you're going to have to pay the tax within 30 days of the completion date. So it's not the exchange date, it's the completion date, but still, that doesn't give you much time to get that return in. So what we're saying there really is, if you're thinking of selling a property, you really need to start thinking of all those things that your accountant will need. But when you have to come to submit that return, because there's not much time at all to be able to do it, and there's also a quite complex registration process, a combination of the actual taxpayer having to do something alongside their agent to get all that submitted. So yeah, that's one of the main things. I mean,
and that will catch people out, because because it's a relatively recent rule change. We're seeing people panic about that because they have to, as you say, track down historical information, don't they?
Yeah, and we thought perhaps the solicitors and the law firms would be on top of this and dealing with it, but I only had a conversation this morning with one of our franchisees who said that he's dealing with the sale, and the solicitor and the estate, neither of them knew about these changes. So unfortunately, we think from the government's point of view, they've had much more pressing things, and this is to some extent slipped the net. But we've certainly tried to update our network and clients on that.
Okay, so simple rule: if you're thinking of selling a property, then talk to your accountant and just get a view as to what that may mean.
Yeah, even if you're just thinking about it, because if they don't know, then there's going to be a bit of a panic in getting all this information together. Just one final point is, previously where property changed hands between spouses, the spouse receiving the property used to have to live in the property to inherit their main residence history, so for that property to be exempt then. So the tax service has been generous in allowing a bit of a relaxation there. So again, if you previously had advice on that, you may want to revisit that advice. So that's another change from the 6th of April.
Okay, this is a very quick run through on a connected point. We've put this slide in because this is about the digitalisation of tax, and some of you may have seen Making Tax Digital, or MTD as it's abbreviated to, as being quite a significant change in recent times. At the moment, it's only impacted upon VAT registered businesses, but the point we're making here is that that's changing in 2023 as proposed. That will then affect landlords with property income above 10,000, and we think that's per individual, don't we, in terms of assessment. Why does that matter? Because it will need some planning. Because at that point in time, landlords will need to have digital business records, so that they need to be using compatible software. We've used QuickBooks and Xero as examples as probably the two biggest players in the market, but there are others out there which we understand as well. It's just one to be aware of. What does that mean? Yes, it's still over 2 years away, but if you are looking to start as a landlord, you may want to think about keeping the right records from day one. If you're an existing landlord, there will come a point where you'll need to update your records. That may need a bit of time. So it's just worth bearing in mind for future, talking to your accountants at some point, because you will need some help probably getting that software up and running. So just a bit of an update really on something that will be more relevant as time goes by. Okay, thanks, Darren. Should we finish with some tips in terms of trying to pull this together? I'll let you run through these, Gary, and we'll pick up as need be.
Yeah, well, I mean, the first tip we've had, we've got there is, funny enough, we've had a question come in, which covers that point really, so it's probably best if I go over that question. So husband and wife have a property, and the mortgage and the deeds are in the wife's name, and she completes a tax return and she is a higher rate taxpayer, whereas the husband is a basic rate taxpayer. And what's been said here is, with the changes in interest mentioned, is there anything that the couple can do to split their income differently? So yeah, there are things we can do here. The rules say that income must follow the ownership split. So what we normally do there is, rather than upset the mortgage company too much, we'd approach a friendly local solicitor or one of our preferred suppliers on the legal side and draw up a legal document which says that the wife owns the property on behalf of both of them. And then that gives us much more flexibility as to how the income is shared. You will need an accountant to assist you with making the election off the back of that and sending in the election to the tax office. So you've got to do that within 60 days of that being effective. But yeah, that's one of the other things that we can help you with.
Quite valuable in terms of the difference between marginal rates of tax in that situation.
Yeah, definitely. So the higher rate taxpayer spouse will only be getting the basic rate relief on the interest, but still paying higher rate tax on the income. So definitely worth looking at. One of the things, if you've got relatively low expenses, you can look at the property allowance, which is £1,000 per owner. But yeah, again, you're still going to have to do a tax return and claim that on the tax return. If you've got a full-time lodger or doing some air bed and breakfast, for example, in your home, then you could consider claiming the rental room allowance instead of actual expenses. So that's gone up from, I think, about £4,250 to £7,500. But that is not per property. That is not per property, per owner.
But actually quite
split between the two owners.
But quite a simple way and potentially advantageous in terms of claiming expenses.
Yeah, it might help on your keeping records, but you still need to keep obviously actual records to compare the two. Obviously, when you're completing some accounts, they'll be based on income that's come in and expenditure that's actually gone out, but there may be some other expenses which you can claim, which you might not necessarily have directly incurred. But for example, you can claim mileage to visit the property and to carry out other administrative tasks like banking and sorting it out, insurance, for example. So don't overlook the mileage, and that will be generally at 45p, unless you consider undertaking a lot of mileage. But again, there'll be at 45p. That's quite a generous tax relief. We've already looked at the advantages of furnished holiday lettings, so we see that as quite a big market which people are going to go into. And also consider whether you've actually claimed all of your loan interest. We've spoken about the interest and the restrictions, but to put a bit of an example in there, has a deposit for a rental property been funded from a private mortgage? So you may have built up a bit of equity in your own home. You may have had to have taken out a buy-to-let mortgage to buy the rental property, but you may have funded that deposit from releasing some equity in your own home. So what is often overlooked is that you can claim the tax relief on that interest because the tax officer looking at what purpose you use those funds for, and the purpose of the additional borrowing from your private mortgage is to buy the buy-to-let. So,
and that's very commonplace, isn't it?
Yeah.
People, loan to values for letting properties aren't always as generous as they are for your main residential property. And people, generally speaking, have got a bit of equity and a bit of headroom in their private property, so use that to release value to support the letting property quite often. And that this is missed, isn't it, in terms of that claiming of loan interest, even if it's restricted, as you've talked about. That's still a useful relief to understand if you're using those funds. I guess there's got to be a clear trail of money through an extension or a private mortgage into the deposit that goes into the property. It's not just about using spare cash and saying, I've got a mortgage, therefore I'm attributing against that existing personal mortgage. It doesn't work that way, does it?
No, we definitely need to keep the records to clearly trace those funds through from releasing the money from the mortgage to, being spent on the deposit. So there was a time when there was more flexibility, but tax office have tightened down as they have done with a number of things.
Okay. So I think that's probably, in terms of technical content, that's probably what we want to cover. We'll cover. There's been a number of questions asked, I think, so we'll try and find 5 minutes to come back to those. How can we help? How can our network of accountants help? There's things on the screen there that are relevant. I think though, just to refer back to what we said at the start, this is a complex area. We've tried to give you a flavour of some of the things that we think are relevant. Different people will have different circumstances, but quite often the right advice will depend on your own circumstances. So I think it is always right to get good advice, and hopefully what we've demonstrated is that we as a network are here to help you, and we do understand the ins and outs of exactly how we can support you if you're looking to start a business, develop your landlord business. We can help you in each step because there are a number of different taxes involved, so we are here to help if need be. Should we move on to questions and just have a quick look at what may be out there? So let's have a quick look there. Okay, so I don't think there's any additional questions there that we need to deal with at the moment. I said at the start that if there are any questions we can't get round to, then we will get back to you individually. There is more information on our website, so please do have a look on there. There's a hub we've built for landlords with a whole host of resources, so please do look there and see if that helps you. And please do talk to your local accountant. We are there and open for business. I think we've got the next slide with just contact details. Actually, there's a last question that's come in. Gary, do you want to have a quick look at that?
Yeah, so can you confirm capital gains tax liability? Is it based on the sum that the property has increased in value from the time the rental commenced, and what is the percentage? So yeah, capital gains tax is due on the increase in the value of the property, but not necessarily since you started renting it out. So what will happen is the gain will be deemed to accrue on a straight line from when you purchase the property up until when you sell it, and then that gain is time apportioned. So you may have some of the gain may have accrued during a period in which you were occupying the property yourselves. So that period will get main residence relief, and you won't pay any tax on that bit. But then you will then have a period when the the value has increased or deemed to have increased on a straight line basis. So yeah, you will pay tax. But it's not. The question specifically says, is it just from when the rental started? No, it's on the whole property, but there are various exemptions which you can claim. Yeah, again, advice needed on that one. And the second point, can we claim product fees when securing a buy-to-let mortgage as an associated cost? Yeah, so I think the last bullet point on the finance slide was to confirm that if you've got associated costs with obtaining finance, then that is treated as a finance cost. And so they will have to be apportioned. Well, in this particular tax year, it's all going to be a 20% deduction. For the tax return you're about to do, probably for 1920, you'll be able to claim 25% as against the rental income, and also so yeah, they are deductible, but on the same basis as the interest. Yeah, I see. And the final point, and we will have, this is the last question, there's more coming in all the time. Are development costs post buying a property considered when working out capital gains tax on sale? Yeah. I think the answer is yes. Yeah. Yeah. I think it's quite a simple answer, that one. Yeah, yeah. So we covered the example where if you've incurred costs shortly after buying a property, if they're not deductible for income tax purposes, then you still need to keep a record of them and carry those forward and keep a record of them so that they will be claimed against the CGT.
Right, I think we're going to stop it there. There are some more questions coming in. So for those questions that do come in that we haven't got round to, then we will try and get back to you. If there are questions that spring to mind, then please do talk to your accountant if you're a TaxAssist client. If you're not, we are open for business, even in these difficult times. With free telephone and video consultations, we can meet online, and we always have a fixed fee approach, so no surprises. So please do talk to us if you need to. I mentioned earlier, there is lots of resources on our website, www.taxassist.co.uk. But thank you for your time, and hopefully there was some useful content in there for you. Please do stay safe, and we hope to see you again. Thank you.